Let's talk about money. We use it every single day. But have you ever really stopped to think about why it even exists? It's the engine that powers our entire economy, along with its very close cousin, credit. So, in this explainer, we're going to take a journey all the way from ancient bartering to the super complex world of modern banking to really understand how this whole system works.
Okay, so imagine this for a second. You're an amazing shoemaker, and you've just crafted the perfect pair of shoes. The problem is, you're hungry. You need wheat. So you head over to the farmer and say, "Hey, want these awesome shoes? I'll trade you for some wheat." But what happens if the farmer's already got good shoes? What if what he really needs is, I don't know, a new shirt? Well, this simple little problem, it's the entire reason we invented money in the first place. This tricky situation actually has a name. It's called the double coincidence of wants. And it's the foundation of any barter system. But wow, is it inefficient? Just think about it. You don't just have to find someone who has the thing you want. That person also has to want the exact thing you have at the exact same time. The odds are just not great.
All right, so here's our game plan for this explainer. First, we'll really dig into why bartering is such a headache. Then we'll see how our modern money system came to the rescue. After that, we're going to explore the world of credit, both its incredible power and its serious dangers. And finally, we'll look at a really cool, innovative solution for bridging the credit gap for some of the world's poorest people. Okay, let's kick things off by just imagining how incredibly frustrating a world without money would actually be. So let's go back to our poor shoemaker. Without money, what does he do? He literally has to wander around the marketplace, searching for a farmer who grows wheat, who also just happens to have worn-out shoes and wants a new pair. I mean, that could take days. The whole system just grinds to a halt, waiting for these unlikely coincidences to happen. And that, of course, brings us to the invention that changed absolutely everything: money, and the banking system that grew up around it. So what money does is it acts as a medium of exchange. It's the critical middleman. Our shoemaker doesn't have to find that one specific farmer anymore. Nope, he can sell his shoes to anyone for money and then turn around and use that money to buy wheat from any farmer he wants. Suddenly, everyone is connected. Now, in our economy, money really comes in two main flavors. The first one is the obvious one, right? Currency. We're talking about the physical paper notes and coins in your pocket. But the second form is actually way, way bigger: demand deposits. And that's just a fancy term for the digital money sitting in your bank accounts, the stuff you can access instantly or on demand with a debit card or an app on your phone. So, this is where banks come in, and they play this fascinating role as mediators. Think about it. On one side, you have people with extra cash, depositors. They put their money in the bank where it's safe and earns a little bit of interest. Now, the bank doesn't just let that money sit there. It keeps a small portion on hand. In India, it's about 5%, and it lends the vast majority of it out to people who need it, the borrowers. The bank charges those borrowers a higher interest rate than what it pays you, the depositor. And that difference, that little gap, that's how the bank makes its money. It's the system that keeps cash flowing and the economy humming.
And this leads us right into the other side of the coin: credit. You see, borrowing money can be this incredibly powerful tool that helps you get ahead, but it could also be a really, really dangerous trap.
At its heart, what is credit? It's really just a promise. A lender gives you something of value right now: money, a car, whatever. And in return, you promise that you're going to pay them back in the future. But whether that promise ends up helping you or hurting you, well, that depends entirely on the situation. And these two stories perfectly illustrate the two faces of credit. On the left, you've got Salim. He's a shoe manufacturer who gets a huge order. He takes out a loan, buys his raw materials, hires some extra help, makes the shoes, fulfills the order, makes a nice profit, and pays back the loan no problem. For him, credit was a ladder to success. But then look at the right. We have Swapna, a small farmer. She takes a loan to buy seeds, hoping for a great harvest. But then disaster strikes. Pests wipe out her crop. She can't pay back the moneylender. The debt spirals, and soon, she's forced to sell off her land just to settle it. For her, credit was a trapdoor. So where are people actually getting these loans? Well, if we look at rural India, it's pretty interesting. While banks are the biggest source, look at that big slice of the pie. A massive 23% of loans still come from informal moneylenders, and these are the lenders who often charge sky-high interest rates. Now let's shift our focus to the cities, because this is where a pretty shocking pattern starts to take shape. For poor households in urban areas, the situation is even more serious. Over half, 54% of their loans are coming from these expensive, informal sources.
But, and this is a huge but, look what happens when we check in with rich urban households. The picture completely flips on its head. An overwhelming 83% of their credit comes from formal, cheaper sources like banks, with only a small fraction coming from informal lenders. So what's the crucial takeaway here? It's this deep inequality. The very people who need access to affordable credit the most, the poor, are often shut out of the formal banking system. They're forced to go to these high-cost lenders. Meanwhile, the rich have easy access to cheap credit, which helps them get even richer. That's the credit gap. So this is the huge problem, right? How do you fix it? How can we make sure affordable credit gets to the people who are so often left out in the cold? Well, Professor Mohammed Yunus, the founder of the incredible Grameen Bank, put it perfectly. He believed that if you could just get credit into the hands of the poor on fair terms, they could unleash their own economic potential and create miracles. And his idea led to this brilliant model called the Self-Help Group, or SHG. The mechanics are simple but absolutely genius. Here's how it works. A small group, usually 15 to 20 women, get together and they start pooling their savings, even tiny amounts. Then they start lending that money to each other. Here's the kicker. After a year or two of doing this successfully, the entire group becomes eligible for a real bank loan, without any single member needing to put up collateral. The group itself becomes the guarantee. And the benefits are just enormous. First off, it completely solves that collateral problem, which is the #1 thing stopping the poor from getting bank loans. But it goes so much further. It empowers women, helping them become financially independent, and it creates this amazing community platform where they can tackle other social issues together. So you might be thinking, does this actually work? Well, the numbers speak for themselves. The Grameen Bank in Bangladesh, which pioneered this whole model, had over 9 million members by 2018. And nearly all of them are poor women who have proven time and time again that they are some of the most reliable borrowers in the world. So, the big idea here is simple, but so incredibly powerful. By organizing, by working together, the poor can create their own form of social collateral. They can unlock the door to the formal credit system that, for so long, has been closed to them. This model just proves that a simple, community-driven idea can completely transform millions of lives just by making credit fair and accessible. And it leaves us with a pretty powerful question to think about. What's the next big idea out there, waiting to change the world?